On Friday, we got a weaker dollar, we got a rally on the markets in equities. I mean, what does that suggest to you, that we are going to get a round of quantitative easing, just not at Jackson Hole?
I think so, yeah, and I think expectations that we were going to get a major policy announcement on Friday from Chairman Bernanke were always a bit overblown. What he set out very clearly, and I think reminded markets, is that the Fed has a clear easing bias. We knew that already, to be fair, from the August FOMC meeting, but I think he reiterated that language, the key word, prepared. They're prepared to do more.
Right.
When it comes to the Fed, that's about as strong as they get. So now it's really all eyes onto that next FOMC meeting.
It's always all eyes on the next thing, isn't it? Jackson Hole, that's gone now. Now it's the Dobbs report on Friday, and that's good. Now it's the Fed two-day meeting.
Yeah.
So let's look ahead to that.
Yeah.
What will be the impact for Asia from that again? 2 days, therefore, instead of the one. Something's going to happen. At least something definitely
Absolutely. I mean, we've got some important.
You guys are egging each other on, aren't you? Absolutely, yes.
We've got some important data coming in the next few days. To be honest, you mentioned payrolls. Also, I think the ISM manufacturing survey, arguably more important, given that payroll is probably a bit of a lagging indicator. I think if ISM weakens, as a number of surveys are suggesting it should, say dipping well below the 50 level, that will really signify that this is an economy right on the brink of recession. And I think that sets the table for some further action by the Fed in September.
The impact for Asia?
The question is, what is that action going to be? Our sense is we may see the Fed move to some sort of so-called Operation Twist arrangement, where they lengthen the duration of the balance sheet first, and then maybe move to QE3, the November meeting, or later in the year. But if the data's really bad between now and then, we could get QE3 at that meeting.
I'm going to squeeze in a question before I let you take over in the next few minutes. But is he over-optimistic about the recovery in the U.S.? I mean, markets rally because he says the recovery is intact. How can it be intact when you have 0.4% growth in the first quarter, 1% growth in the second quarter? What is he looking at?
I suppose technically it is still a recovery, but we're talking a very.
I wouldn't be over-optimistic about it.
This is officially, I mean, Bernanke called it one of the weakest recoveries on record. We've crunched the numbers. This is the weakest recovery on record since the 1930s. We're 9 quarters into it now. We still haven't regained the previous peak. So I think the Fed chairman is wildly over-optimistic. We at BNP Paribas think the US is going into recession. We think you're going to see likely negative growth in the fourth quarter. And that's really why we think QE3 is a strong probability by, say, at least the November FOMC meeting.
All right, Richard, thank you for that.
Yeah, Richard, more from you, please. Don't go away. Richard Iley, the chief economist at Paribas. After the break, welcome back and join me once again, Richard Iley, the BNP Paribas chief Asia economist, excluding Japan. So we won't discuss the election, obviously. Before the break, we discussed with Susan the impact of quantitative easing through the next Fed meeting. Let's talk about the impact on Asia. Let's talk about which countries would suffer the most. Obviously, in thinking China.
Sure. I mean, it's sort of in advance of that, we've been taking a look at which countries are the most exposed around the region in advance, exposed to, say, US and even Eurozone recession, which we think is going to be a close call as well. So we've really got very bearish on the outlook for G2 growth. And the answers are quite interesting. It's actually, in terms of direct trade exposure, it's Thailand and Malaysia are the 2 economies in the region which are the most exposed. Now, there's a neat symmetry here, which is actually when you look at, say, the movement of their exchange rates, their interest rates over the last, say, 2 years, they seem to be the 2 economies that have most successfully normalized monetary conditions. So we're advising our clients we could see potentially a pretty rapid turn in, say, the rate cycle in, for example, Thailand. They hiked rates last week in a slightly surprise move because they've got a big fiscal stimulus there. We could see an economy like Thailand or even Malaysia, pretty quick turn in the rate cycle.
That's very interesting because many that I've talked to, strategists, equity analysts, are saying that Thailand after elections is arguably for them the best growth prospect and investment prospect in Asia.
Yeah,
and
well,
this could happen.
Well, you've got this big fiscal stimulus coming in. That's one of the main reasons why the BOT felt necessary to hike rates once more. That essentially they think these downside risks to growth, to exports that are building very quickly, broadly offset for the moment by this fiscal push you're getting from the new government. But it may turn out, a bit like India 3 years ago, that what may have been an ill-judged pro-cyclical fiscal expansion ends up being a perfectly timed counter-cyclical fiscal expansion if the US goes into recession as we now think.
Well, let's talk China, Richard.
Sure.
And you've got in your notes here that China's growth 8 to 8.5% at worst.
Yeah.
Any country would beg for that kind of growth.
No, absolutely. I mean, China and India, we think, are still going to be the fastest growing economies in the world.
But there is the correlation with China for the US, the inflationary impact, and of course the China-US trade situation.
I'd make 2 points at least in passing. One is that we think this is very much a two-speed world. The fundamental drivers of growth here, really why Asia has been able to decouple over the last 3 years, still largely in place. Sure, China doesn't have the room for manoeuvre to put in a huge fiscal package of the order that it did, say, 3 years ago, but it's still got scope to ease policy through the balance of this year if inflation comes off, as we believe it will, over the next 3 to 6 months, because cyclical inflation pressures are now really falling away. So that's the key for me, that downside risks to growth are building for the region, but in turn, that is moving inflation risks to the downside as well.
China has the extra one of wage inflation, doesn't it? As well as the food inflation and everything else, but the wage inflation is particular to China.
Yeah, sure, but we've got to distinguish to some extent between good inflation and bad inflation. A lot of the bad inflation, we think, food prices, higher oil prices, global manufacturing prices, that bad inflation, if you like, will begin to wane. Faster rates of wage inflation by themselves not necessarily a disaster for the Chinese economy. We all know that China needs to rebalance to a more consumption-driven growth model. Actually, faster wages, a bigger share of the economic cake going to workers is a key part of that. So I would characterize that as good inflation. No one's talking about China sliding into deflation, just cyclical inflation pressures abating enough for the authorities to take some measures through the course of this year to shore up growth if need be. We suspect that will be needed.
Thanks for coming in, Richard Iley there, the chief economist at BNP Paribas for Asia, ex-Japan. Now, some other